We can settle in. I'd like to call to order the meeting of the South Carolina Retirement System Investment Commission for today, March 5th, 2026. We have an agenda in front of us. Call for a motion to adopt this proposed agenda, please. I have a motion. May I have a second?
Second.
I have a motion and a second. Are there any discussion to be had before we have to vote on the adoption of the proposed agenda? Hearing none, all in favor of adopting the agenda in front of us, please say aye. Aye. Those opposed, respond likewise. The ayes have it. We have an agenda. Thank you very much. All right, next on the agenda here is the approval of the December 11th, 2025 minutes of that meeting. I assume everybody's had a chance to review these. I'll call for a motion to accept these. I have a motion. May I have a second?
Second.
I have a motion and a second. Is there any more discussion on the approval of the minutes from the December 11th, 2025 meeting? Very well. All in favor say aye.
Aye.
Any opposed likewise? The ayes have it. Minutes are approved. Next up on the agenda, we've got the presentations from GRS Actuarial Consultants. I'm going to turn it over to you, Mr. CEO.
Thank you, Mr. Chairman. We have Joe Newton and Danny White appearing by video conference with us today to talk about the actuarial evaluation for our various retirement systems that we have the honor and privilege of managing the assets for. As you know, this is something that is done yearly as part of the actuarial work that we have from GRS. So I will turn it over to Joe or Dan.
Thanks, sir. It's a pleasure to be here virtually. My name is Danny White, and I'll take over the first half of the presentation, and Joe will kick it off and end it out with some projection, sensitivity information, and kind of things to think about going forward. If we go to the next slide, we got an agenda. This is a very similar presentation that we provided to the people board in December to kind of give some idea on timeline. The actuarial valuations are performed every July 1, and it's a monstrous effort. It takes a lot of work to do, and they're presented to the people board in December, usually the first week of December. And so everything that we're talking about today is a little out of date, especially when you think about on the investment side. But we've definitely come with some good news. We'll go to the next slide, just understanding some idea on demographics. We look at the contributing membership for SCRS. So there's various different classes of members that may or may not be earning benefits in SCRS, but you do collect contributions on. Class 2 members were hired prior to 2012. Class 3 members came in after 2011. The state ORP, that's a state, that's a defined contribution plan. But again, the state makes contributions on the payroll, those members to help finance and fund the unfunded liability in SCRS. And then you have working retirees. So if working retirees are no longer earning future benefits in the system, but they're drawing and receiving a benefit, and they do come back to work or seek reemployment, they are contributing members as well. So both member and employer contributions going on payroll. And again, that's going to help fund the unfunded liability. So you can see how it's changed over years. The size of it really depends on the economy. There's nothing special in the projections or all that. We've seen some growth the last 4 years. It's yet to be seen how much growth will that continue. That'll just depend on state and local government budgets. We go to the next slide. We've looked at active members. We go to members collecting benefits. And you can see how that has changed, both in the members, on the member side, and then later on, we've got cash flow information. So you get to see how it impacts money coming in and money going out. But you can see just how that changes, and you can expect that number to continue that upward trend, well, at least the next 5-7 years. So we go to the BAL results, and if we could go one more slide there, perfect. Three things all had momentum to the BAL results that we saw this last year. First of all, it was the asset return for FY25. You can see it was almost 1.6 billion more than expected. That's compared to the assumed rate of return for SCRS and about 300 million for PORs. The other thing is that was working for the system was the contribution effort, and that's the contribution effort made by the state employers as well as the members. It's no small amount, and that contributed to what we have also to decrease the unfunded liability in the system. And then the last part that also was some tailwind was we saw active membership increase and payroll increase. And it's the payroll increase, again, that's more driven by the economy, the state budgets, local employer budgets. This was something we experienced across the country. So that type of experience is not unique to South Carolina. Some of the question will be how much will it continue? What will it look like next year? We're starting to already hear about state budgets not having the extra room like they did the last few years. But where that's important on the payroll is that's your revenue source for collecting contributions. So as Joe will show later on, even though the contribution rate itself didn't change, you got a lot more money in contributions coming in just because of that source of payroll or that revenue increased. We go to the next slide. Again, this is the highlight, and it's gonna be a theme we're gonna say a few times over. But the unfunded liability for SCRS and PORs went down from the prior year. So it went down by 1,468 million for SCRS and about 224 million for PORs. So you can see how that's impacted the various aspects. You got kind of the balance sheet on top, that being your actuarial accrued liability, the assets, the funded ratio, and then you can see on the contributions, and on the very bottom, you can see the cash flow coming in. And so even though where we've highlighted the contribution rate itself hasn't changed, we expect more in terms of contribution just because of that payroll base, anticipated change in payroll base. Are there any questions on this before we skip to the, or we move on? All right, very good. Not hearing that. We've got, if we could back up just to the smaller plans. JSRS is the judicial system. GARS is a General Assembly retirement system that was closed to newly elected members after 2012. And then you have the South Carolina National Guard provides a supplemental benefit to National Guard members. And again, you got a similar theme that contribution effort, positive experience, the unfunded liabilities going down, funded ratios are improving. So with that, I'll turn it over to Joe for projections.
Oh, thanks, Danny. So the first thing we're going to talk about is cash flows here. You can see we have the way the projection slides are set up is the solid colors to the left are the actual history of the given item we're looking at. And then the more fuzzy colors to the right are our projection of those given items. And so you can see that as of 2025, and I'm sure you're aware, the contributions actually surged up above the payouts. There was actually a positive cash flow these last couple of years. That was not already expected. That was mainly due to the surge in population, the headcount, because the contributions are based on that payroll. And so that surge in payroll pushed up the contributions. You can see here, if assumptions are met, we would expect it to kind of revert back to more of a negative cash flow position, although a pretty minor one for the next few years. We go to the next slide. This is the historical liabilities and assets. So the red line there, that represents what's owed to the membership. That's the liability due. And just like the previous slide, the solid line is your the actual pattern has been. The assets on the bottom, we use smoothed assets for all of our calculations on a 5-year basis. That's the blue line. And the green market, you can see they track very well, kind of back and forth. But this projecting forward, you can see that we anticipate this gap to close pretty quickly here and reach full funding there around 2035, 2036 timeframe. Now, as we go to the next slide, this is a history of the unfunded liability. And then the next few years, and the reason we want to point this out, as Danny said earlier, this blue line turned down this year for the first time, right? You looked at it for this whole period. Back in 2011, it turned down, but that was due to benefit changes. That wasn't natural history, experience. Here in 2025 was for the first time. If you go back about a decade and look forward, we were expecting it to begin to come down in fiscal 24. However, if you remember last year, there was big salary increases and that pushed up the unfunded liability, kept it from coming down. This year with the liabilities cooperating, and then of course the asset performance being very strong, we began to see the unfunded liability coming down, and then the red dotted line is where we expect it to go now. So the next slide. This is the projection of that unfunded liability, which is the bars, and the funded ratio, which is the lines. The light blue bars and lines are last year's. So what we were saying in the same meeting last year. The dark blue are this year's. So if you see the unfunded liability there, the dark bars are anticipated to pay off quicker than last year's pattern was. And in fact, it should be coming down pretty quickly now. The lines, the funded ratio, we should be improving here. Takes all the way, they get to 100% funded at the same time the unfunded liability pays off. Those are just inverses of each other. But the one item we do want to point out, and we'll talk about a little bit more, is the 85% funded ratio there in 2034, because in the statute, that's the first times the contribution rates could change. They don't have to, but that is the first time they could. So at least for the next decade, we're currently projecting that they won't. But then once you get to 85% funded, the question becomes what then? So we go to the next slide. This is giving a little sensitivity to the speed of becoming 100% funded. And this is talking about contribution rates, because this is assuming once you get to 100% funded, the contribution rates could drop. So you can see if the fund continues, around 9% annual returns, it could be as quick as 2033 that fully funded is reached. If we're using something closer to our assumption, you can see 2036. And then with 6% returns going forward, it pushes out to 2039. So somewhere between 2033, 2039 is kind of like the high probability range of that timeline. Next slide. I'm sure being the investment commission, like to see, not straight lines, more of a probability model. And so that's what this is doing. This is comparing some different questions we could ask and seeing what the probability or likelihood of those occurring, and then compare to what those same probabilities were the last couple years, because we're really looking for the trends in these models. So what's the probability we're over 85% funded in 2035? You can see 2 years ago it was around a 50-50 chance, up to a 67% chance now as of 2035. Getting to 90% by 2040. You can see that's improved from 59% 2 years ago all the way up to 81% now. Likelihood of being above 90% by 2040. As the actuary we're looking for is that unfunded liability to get smaller, and so you can see if we're just sitting here looking forward 5 years, should that unfunded liability be smaller 5 years from now than it is now? Up to an 84% chance now that is the pattern that's going to occur in the next 10 years, 86% chance that would occur. So it's going to take some pretty substantial negative experience for that not to occur. And then at the bottom is from the employer's perspective, what they're going to mostly focus on, what's the contribution rates, what's the likelihood we're going to need more based on the 20-year requirement in statute. And you can see that is at 9% probability that we'd ever breach that 1856 based on current expectations. So a lot of improvement across all these probabilities, and that's exactly what we're looking for. So if we go on, we'll run into PORs. It's basically the same story. So very similar pattern, except here you see we've had a gigantic surge in headcount, and payroll has really pushed those contributions up. Again, those are the same contribution rates. It's just the amount that they're being applied to has really surged. And you can see that based on normal patterns, should contract back down, getting back into something close to a negative cash flow, but it takes quite a few years for that crossover to actually occur for PORs. Let's go to the next slide. This is the same graph, but with the PORs, you can see that they look very, very similar. And we'll reach full funding in about the same time based on current assumptions being met and the contributions remaining in place. Next slide, same story. Again, the unfunded liability, the improvement from last year, we expect the unfunded liability to pay off quicker than previous years, and the funded ratio to improve a little quicker than previous years. All right. So just to summarize, this was, the first year for the unfunded liability come down. So I think this is very important, because as we talk about funding periods, or how long do we expect it to be till the unfunded liability is paid off? Well, if it can't go down 1 year, how can it possibly be paid all the way off? So it's good to see it actually decrease year over year. Of course, now we want to see that for multiple years to start a trend, but this is what I consider kind of tangible evidence. It's actual evidence, not based on hope, that this plan is working and the unfunded liability is beginning to decline. It's very unlikely that more contribution rates will be needed based on the current expectations and assumptions. But as we showed, there is a small probability that are sitting out there. And so we're going to now talk about that 85% funded ratio a little bit. But first, before I do that, is there any questions about the valuations or these projections you've seen before we kind of talk about what's next?
This is Mike Hitchcock. I have one real quick. I think it may be surprising to some that, we talk about that there's the amortization period for SERS is 12 and the amortization period for PORs is 11. But last year was the first time that the unfunded liability actually decreased.
Right.
And I think it just may be helpful, to think about, there were a couple of factors in there that we also had to compensate for, which included, since the 2017 pension reform legislation, which was we decreased the discount rate, we lowered the discount rate twice, from 7.5 to 7.25, into 7.25 to 7. And I think that had like over a $3 billion, impact total to the liabilities. So increase, right? Yeah, increasing the liabilities. And then there's that, and I think you hit on this, but there's that kind of countervailing effect between payroll growing faster than what we necessarily expect it to, and that which has happened over the past couple of years, because there's a kind of a short-term kind of hit to the liability, but there's a long-term benefit because of the additional contributions that you get. So, there's stuff going on under the hood that, provides the explanation of why to not necessarily be surprised that this is the first year that the liability has actually gone down, if that makes sense. Yeah.
Right, and a lot of those contributions were phased in, right? And so
that's right.
While they're ramping up, it's hard to get it to turn over. You kind of have to get to the top. So
I have a couple questions. I apologize for my lack of understanding of this, but what's the unfunded liability represent?
Okay, so let's go. Can we go back? Just 2 or 3 slides here. Just that one. Okay, so this is for no, one more down. There you go. So this is for PORs, but it's the same idea for SCRS. So that red line, the actual accrued liability, that represents what's owed to the members. So if you think about, a current retiree, we can project out what we expect to pay them. They should have already earned all that. They've provided all their service. So it's the total, for lack of a better word, debt that's owed to the members. The same thing for actives. If someone's worked 10 or 15 years, there should be a certain amount of money that's been set aside for that person to pay those benefits, what's owed to them already. So that's what that actual accrued liability represents. And so you can see here in Poor's case, that red dot here in 2025 is up around $11 billion. So that's what's owed. And so now we need to cover that with assets. So compare this to a mortgage example, right? So if you owe money on your mortgage, you can just pay money towards it and then that goes away, right? The debt just goes away. Well, in the pension world, that's not quite how it works. In the pension world, it's more, let's say I owe you $100. I actually can't just write a check for the $100 and make it whole. The only thing I can do is, every month I'm going to start paying you $1 a month, right? It's a long-term process that you're paying out what's owed. And so what you want to do is securitize that debt, right? So if you owe the members $11 billion, what you want to do is say, hey, we're going to accumulate this $11 billion over here in this account, the savings account, so that you can see we're good for it. It's completely securitized. And so the unfunded liability represents the difference. How short are you right now, just today, between what's owed to the members and everything you've got in the bank right now? And so you can see there in this case, that is the difference between the red line and the green or blue line down here. With the green or blue line is what's in the bank. The red line is what we would like there to be in the bank to make sure we could tell all the members right now, you're covered with everything that's already in the bank. We're not needing future contributions to make sure we can cover what we already owe you.
That's a great explanation, Joe. If I may add one more item, and I'll be brief, but the accounting world also uses debt. It actually sits on the state and local employers. A share of the total unfunded liability sits on as debt for the participating employers in the system.
Right. Well, aren't the contribution rates that are currently in place, don't they include what's, I guess, going to be funded in the future?
Yeah.
So
I guess to get to break even.
right. So
Somewhere down the road.
Yeah, and that's where the funding period, that's what we're talking about. Like, how long do we expect to pay off this unfunded? Because you're right. There's a lot of contribution coming in to pay off it unfunded.
Yeah.
But the unfunded liability from a pension world is just right now. It's just a snapshot.
So let me ask you
a funding source.
Let me ask you one more question. Would there be any incentive to pay off the unfunded liability that sits there today for the state? In other words, just get rid of the liability rate if they have the assets, which apparently we do, kind of.
Well, can I jump in real quick?
Sure.
So, a couple of things to think about, Ken. One, the actuarial value of the unfunded liability right now is somewhere in the neighborhood of $27 billion.
$27 billion.
Right. So, am I right, gentlemen? Somewhere in that neighborhood.
Right.
Yeah. Combined. That's across all
systems. Yeah.
Across all systems. Right. So, and even if and the other thing to keep in mind too is the liability is the net present value of the liability. Right. So there's hundreds of billions of dollars of accrued benefits as far as the benefit stream out through time that are owed to our beneficiaries. The 7% is how we discount it to give it a net present value, right? So even if we could write a $27 billion check, right? Then in order for us to keep pace on that red line, like let's say we were all those lines,
decrease rates.
Well, you would still have to earn 7% in order to earn 7% on your assets in order to keep pace.
You would have to increase the rates also, I think.
Yeah. So what you see here is the difference in the contribution rates is the normal cost of benefits is about a little bit less than 11%, and this is an SCRS,
Yeah.
but we use
Yeah.
SCRS as an example. It's a little bit less than 11%. The total contribution rate between employers and employees is 27.5 or 27.56%.
Yeah.
So 17.56% of that 27.5% is what is necessary just to catch up,
Mhm.
right? So that's the catch up piece, right? So you earn 7%, they make, contributions are made in that amount, then that's how you catch up over the expected time period. So it's those two things working together, because at the end of the day, the system just needs cash,
Yeah.
and there's two sources. So, and that's what you need to do in order to catch up.
I agree with everything
Sure.
you're saying. Just so when the unfunded liability is paid off, I guess, right, in the future?
Right.
That we figured right now, what happens?
Well, if you keep the same discount rate,
Yep.
then, I mean, theoretically, if you keep a 7% discount rate, you would need to earn 7% on your assets, and you would need to have contributions that cover the cost of benefits.
Yeah.
And if you can do that, then your system will work
You're
fine.
covered.
Right.
Yeah.
Which means at some point, those what I think we're going to talk about this in a minute, but what Joe and Danny have alluded to is at some point, those contribution rates that are going to fund the unfunded liability can start coming down.
Yeah.
What's important though is how they come down, because when you get the fully funded, the theory is you should only be paying somewhere around normal cost, maybe have a little bit of extra just as a margin of safety.
Yeah. Okay. Good.
So unlike a loan, you never really pay this off.
Right.
You fund it, you just have assets to fund it.
Yeah, that's
The
right.
question is, you have enough assets to fund the liability in the future, right?
Yeah, and you have contributions that come in to pay the normal cost of benefits that are being accrued.
Yeah,
Contributions cover the normal costs.
Things are always changing.
Yeah.
That's right. Yeah,
And you're never guaranteed on the rates you're gonna earn.
that's right. That's right. Yeah, so you think about too, like what is there's two levers, there's employer and employee contribution rates, and there's investment returns. Which lever do you actually have control over? Contribution rates. So.
Are there any states that have, like, break even on the unfunded?
Sure.
Really?
Yeah, there are.
There's a handful, but not very many yet.
Yeah, not a lot.
But there's a lot similar places where you are, where they're putting in a lot of money, and we're talking 10 to 15 years. We'll have several plans getting there if assumptions are met, right? If things are
Mhm.
different.
Okay.
Yep.
Any other questions for our friends from GRS?
Yeah, I have one more point. If you can go down, I have one more slide. We just kind of want to talk to. We've talked to the people board about this, and I've had a conversation with Mike and your group a little bit to begin this conversation, which is, okay, how should these contribution rates come down? Because if you think about it, in your case, we project out in 2035, if you just allowed contribution rates to stay where they are now, and then as soon as you're 100% funded, let them drop all the way to the normal cost immediately, you guys would jump from like a -1% payout to a -5% payout overnight. And in general, that's probably not the optimal approach. And not only from a risk management standpoint, but just from an investment standpoint, right? Like, would the portfolio you have now be the portfolio you would have then? How would that interact with what you're trying to accomplish? And I don't have answers for it, but I have a lot of questions that I think we need to work through as a group, and say, okay, when we get to 85% funded, what is the policy we want to put in place? I think waiting until we're 85% funded and then trying to make those decisions on a year-to-year basis, it would be a bad outcome. I think you'd get a lot of self-serving type decisions. I think starting pretty soon, and even now, and put a policy in place that, okay, once we get to 85, this is how we're going to make the decision, or this is what the mechanic we're going to use to begin to provide the contributions down. Should we target past 100% funded, right? Do we have to necessarily stop at 100? Could we provide a little bit of a cushion? Should we lower the discount rate over the long term to provide that cushion? Should we slow down how should the contribution rates come down slowly, 1% a year instead of just all at once? Those are the kinds of questions I think we should work through as a policy, and that way there's no surprises to anyone. There's no surprises to stakeholders, but also you as a group trying to invest the money would be able to have a better idea of what that pattern will look like and fund to it. Because as you guys have just talked about, this isn't a liability. This isn't actually a liability model. This isn't actually there's some sand on this scale over here and we can just take the sand off. It's cash flow, and it's cash flow over time. And how do we meet those obligations in the best way, in the most efficient, risk mitigated way? So anyway, this is a discussion. We don't have all the answers today, but don't be surprised if you start to hear more and more about this as we kind of work with your group internally and PBA board to put together a policy on this.
Yeah, just for the commission's perspective, this is something that we've been thinking about and working on from our perspective for a while and thinking about. And we've had great conversations already with GRS and we've talked to PBA as well about putting together a working group, probably that would start, looking at this in earnest and trying to come up with some sort of plan for when we get to 85% funded. What's what do those contribution rates decreases look like? I've used, I think, the adage with all of you guys. We need to land this thing like a plane and not like a helicopter, because we need to be able to react from the portfolio perspective to the changes that need to be made in order to compensate for those negative cash flows, and what are the knock-on effects to the assumed rate of return and all those other variables. So it's great that we're having these conversations now. That's exactly what we should be doing, and I think putting together a plan that but obviously will change because of conditions that we can't necessarily predict this far out, but having something a plan to start from that can be flexible and adapt to realities when those contribution rates can start coming down is something that is, I think, very much a primary goal of what we should be doing over the next few months.
I've got a question. This is Bill Condon. If the title of the slide talks about after 85% funded ratio is attained, and maybe we'll start reducing contribution rates and lower the return assumption. So it just seems like, without putting pencil to paper or doing any analysis, we're not gonna, the funded ratio isn't gonna be on an upward trajectory anymore. So how are we, so what confuses me is talking about a target funded ratio of 100% or more. It just seems like if we start reducing the assumption and the rate and the contribution rates, we're not gonna get to 100%. So I'm just.
You're 100%. You are exactly correct, and that's exactly why it's important to have the conversation ahead of time. Because because you're right, if you do too much too soon, then you don't accomplish the goals your objectives. But if you wait and we don't do anything, and all of a sudden we're 80 or 88% funded, and a group that might start with an L looks over and says, oh, we can lower contribution rates, and just starts hacking at the contribution rates, then you're exactly right. Now we're not improving anymore. So I think that that's why having a policy written down that accomplishes the objectives, states what the objectives are. Like if the objective is to get to 110, well then write that down, and that way we're all on the same page and pulling in the same direction. So.
Okay, I'm with you. That sounds right. I guess in the back of my mind, or maybe the front of my mind, I'm just thinking about the people across the street here at the General Assembly. That there certainly will be some, and I'm not making a judgment call on that decision. Wanting to use those funds for other purposes once we get to the 85% level.
Yeah, the other thing, that we're gonna think.
And I guess that's why we need a plan and show them why we don't think that's the wise decision.
Right. Well, the other thing that we need to think about too is, there's there's always pressure across the street on the benefit side too, right? Which can impact the liability as well. So, those things can factor in as well.
Yeah.
And, so we've started having conversations with Senate Finance staff and House Ways and Means staff and have started drawing kind of the picture of, this is where we were, this is where we are, this is what we need to be thinking about. And, when you're getting these types of, requests for changes in benefits and that kind of thing, just be mindful of how that affects kind of the path of contribution rate decrease, or can affect the contribution rate decrease. But again, having a plan, I think, is our best course of action. Because at the end of the day, everybody just needs foreseeability as to how this could potentially play out.
Right.
It's probably not going to play out exactly as we planned, but at least we know our starting point, wherever that is, whatever we kind of land on. And then, the plan's going to adapt as, markets change and there's other factors involved as well. So.
Okay, yeah, thank you.
Anything else from our actuarial folks?
Thank you for the time and opportunity to speak with you today.
Thanks, Joe. Thanks, Danny.
Thanks for being with us. Mr. Hitchcock, what's up next?
Well, we have our Ian Toner with us from Veris. He's going to walk us through Veris's 2026 capital market expectations, and as well as, I think, Mark may introduce them, or I don't know.
Yeah, I think most of you have met Ian Toner before, but Ian is our Chief Investment Officer, and in that role, he's responsible for our forward-looking capital market assumptions. So every year, we publish 10-year forward-looking return and risk assumptions for all the major asset classes. But in addition to that, he's going to cover that at the tail end, and we're going to show how that impacts your expected return, at least based on our expectations. But he also, every year, publishes a paper with 10 thoughts or 10 expectations for the coming calendar year. So he's going to walk you through our last year expectations, and we give ourselves a report card. So he'll show you how well he did last year, and then give his outlook for 2026 as well.
Will that include what's happened in the last 4 or 5 days?
Anything happen? I don't.
Yeah.
Wow.
Thank you. All right.
It's all yours, Ian.
Thank you, Mark. Thank you all. It is always a pleasure to be here for both business and culinary reasons. You are the source of the acme of all American food, shrimp, and grits. So, and it's always a pleasure to come. So, what we have today is two things: the discussion about our 10 thoughts, and then a discussion about capital market assumptions. Here we go. Excellent. Fabulous. So, Mark was slightly including he said we mark ourselves on how we did. That's a very generous we. I'm the poor schlub who gets a name on the paper with the input from my team. And then the chair of our investment committee, who has absolutely no involvement in writing the paper, is the one that marks our homework at the end of the year. So there is an arm's length independent oversight. But we're quite proud. We've been doing this for a number of years, that we think it's important that if we're going to put a bunch of stuff down in writing and say we think these things are going to be important, it's our responsibility to kind of hold ourselves accountable at the end of the year. So looking back on last year then, we came into last year, as many of you will remember, with everyone convinced we were moving into the end times. Markets were going off, interest rates were going to collapse because the economy was going to be terrible. The equity market would be awful. Wolves would be roaming the streets, hunting down children, so on and so forth. It was kind of a gray, miserable sort of a picture, and we were a little bit more positive than that. And I think that positivity was justified. So we began by saying we would expect economic growth surprises to the upside. The economy was strong, continued to be strong for most of the year, and indeed the fourth quarter number was, there was a point where it looked like it was going to have a 5 handle. That's not realistic, but it was still a strong economy. And why? Because underlying this, a large free economy blessed with freedom of movement, freedom of trade, freedom of speech, the rule of law, massive resources, and so on and so forth, and relatively peaceful neighbors to the north and south, and large bodies of water to the east and west. That's a good environment for general economic growth. Typically, things happen to diminish that positive momentum when something gets in the way, and we didn't see things getting in the way last year. We thought inflation was going to continue to be stubborn, but we didn't think it was going to spike again. That was broadly the case. It's continued to come down to lower levels, but not where we'd like it to be. We were technically wrong on the next one. We said higher, not lower. We would expect interest rates would be higher than expected. Between the time we hit print on that, the market kind of adjusted, and this was in the price, the measure that we had. But we expected with that higher growth environment that the market was expecting, interest rates would be a little bit stickier as well. And we expected the credit spreads would continue to be tight and that you weren't going to get paid an awful lot for credit. My constant joke about credit is credit investors are investors that can do math. So we trust their view on the expectation of what's going to go wrong, because their upside is capped and their downside is effectively, their whole investment if they get it wrong. So they focus hard on what could go well, what could go poorly. So we thought credit spreads would remain tight, and that indeed happened. Investors were right that there wasn't going to be a credit crisis. Next was domestic politics and how to deal with the new administration, how to assess the new administration. And we thought that the right approach was sort of the approach that worked for investors last time round, which is, I've always used the analogy of First World War and Second World War tactics. I remember my grandfather fought in the First War trenches in the British Army right from 1914 through 1918. The First World War was an exercise of inches, and every detail mattered, and it was every inch you take. And a lot of politics, as we know, is the statement comes out and there's a comma there, not a comma there. What does that mean? And if the implicit deal isn't honored, then something's gone badly wrong behind the scenes. And that's normally not a bad way of assessing what political impact on economies and investments is going to be. That is not the way to assess the current administration, which is more sort of direction of travel and speed of travel, and the details will work themselves out. So the first press statement and the second press statement and the third press statement, if you worry too much about all of the wording, you're not going to really be effective in terms of understanding what the implication is likely to be. And tariffs were a good example of that. We'll come to in a second. But that approach of seriously, not literally, turned out to be not a bad way of assessing things. There were lots of times where the administration pushed harder than people would expect. But you'll remember the rise of the phrase the taco trade, part of the way through the year, recognizing that the administration has an approach that sort of rhymes. They come into your house, they see a birthday cake on the table, they want the birthday cake, they say, I'll have that birthday cake, and you go, oh, they were going to take my birthday cake, and they leave with a slice of your birthday cake. They got a bit of cake, but they didn't get the whole birthday cake. And that's not a bad way of assessing what, the approach. It's all a negotiation. So don't freak out about the first press release and sell everything and run away to the hills crying. Again, this is not pro or against any administration or either side of the aisle. We are studiously neutral, and I'm for it. So I'm not going to get into that mix. However, that wasn't a bad way of dealing things. We didn't get right the tariffs. We thought that was going to be another space of seriously, not literally. We thought tariffs would rise, but it wouldn't be quite as, shall we say, oomphy as Liberation Day was. But when Liberation Day happened, we put out a note saying, don't panic. This is going to be, we're not going to land where we are, and it's probably not going to break the world. And so we kind of got that wrong, but the underlying thematic thing we're still relatively comfortable with. We thought that active managers with global opportunities, in other words, a global portfolio, a global allocation, would continue to have success, and that's been the case because it allows them to really allocate to where the best opportunities are rather than constraining their opportunity set. We thought that regulation around cryptocurrency would get a lot clearer, and that the administration was going to be a pro-crypto administration, which doesn't mean it deserves a place in institutional portfolios universally, but does mean that some institutions who are beginning to put crypto into portfolios would have the regulatory environment they'd be able to do that. Small cap We thought that successful small cap investors would have opportunity, but small cap was unlikely to perform better than large cap. And we thought that the move towards, I use the phrase, is inevitable even a word? I looked it up, yes it is. And if it's not, I'm going to use it anyway. If it's good enough for Shakespeare, it's good enough for me. To make up your own words. But the key story here was that for 20, 30 years, the story about China as an investment opportunity was partially around the inevitability. Well, China is inevitably going to grow bigger than everyone else. It's huge, so on and so forth. And that story is off the table. It is a small part of global capital markets. There are political reasons why you might or might not want to invest there. There are economic reasons you might or might not want to invest there. And it's really not the biggest fight. And that inevitability component of the story is sort of off the boil. Plenty of institutions that want to be there. There's plenty that don't. And that story we thought was going to sort of come to fruition. So mostly we're pretty comfortable with where we came down last year. We thought that was a relatively good set of things to think about and talk about with some success. Any questions about that? Yes. No? Okay, so 10 thoughts for this year. So 3 starting points about economy and interest rates. GDP, we thought that, we think that GDP is going to continue to be stronger than the market expected. When we wrote it, I think forecasters were forecasting like 2.2. We said 2.5 as a starting point. Wouldn't be surprised if it was better than 2.5, but a lot of these things, the goal is to be directional rather than to nail the exact number. We think the economy is continuing to be relatively strong. We think, as we'll see later on in the description, there's the possibility of, manufacturing renaissance is the wrong way of putting it. That's a little bit overclopping it, but some positive growth across industrial and manufacturing sectors and so on and so forth, more than people are expecting. And that in general, there's enough reasons to believe that the wheels are not going to fall off, that GDP is likely to be a little bit higher than people are expecting, than forecasters are expecting. At the same time, there's likely to be that same sticky inflation that we saw last year. Down again, probably a little bit lighter inflation than the previous year, but not down to the level the Fed would ideally like it to be. And that there's likely to be enough justification for brickbats backwards and forwards that is going to make people concerned about whether there's going to be the inflationary pressure. The tariff story is mostly over, but not completely over. The onshoring story, that's the next step of the tariff story, is there's going to be questions about what does that mean for labor prices and so on. We've just had an oil price spike after these came out. There's the possibility for stickiness in inflation. There is a potential area where we might get a negative surprise in inflation, which is a good thing, which comes to immigration policy, which I'll talk about in a second. But if you see continued net reduction in total number of people, for every 1% growth in a city's population, CBO forecast, you get about 40 basis points of increase in rental prices. And so if you start reducing people, there's fewer people because there's net X migration, then that possibly can have a lowering effect on rental prices and owner equivalent rents, 30-35% of the inflation number. So if we get a surprise read through from the effects of immigration policy, you could see a downward surprise on inflation, but still likely to be sticky and higher than the Fed would ideally like, which means interest rates we expect will be unexpectedly uninteresting, by which I mean everyone came into this year going, this is the year of the new Fed chair, and everyone's going to be yelling, and it's going to be an interest rate story. And the reality is the market and the Fed are both kind of aligned. We'll get a couple of interest rate cuts probably. If you get some mild positive growth and a little bit of sticky inflation, there will be lots of yelling. I guarantee you there will be yelling, but probably there's not actually going to be many surprises in terms of the path of interest rates. So that kind of puts that story a little bit more on the back burner unless we get a big economic shock.
Ian,
Yes, please.
you go back to number 2
Yes.
on the housing rents and
Yes.
and things maybe coming down. That's really already happened, hasn't it? It started to happen.
So it depends on the market, and it depends on the bit of the economy. There's freeing up in the housing market. There's already signs in places where there is an increase in immigration enforcement causing people who are not fully papered to be here. There's anecdotal stories about there being an impact in the housing market. We've not seen significant reductions in the housing component of CPI.
Well, that's
yet.
that's where I was going to head.
Yeah.
Part two was it seems like continued reduction would harm the residential and maybe even commercial, like real estate.
So there's a really interesting question there. We'll come on to the immigration story in a second, but there's an interesting question there, which is the tie together and the nature of the housing and other real estate stock. The place that and you'll notice this story about tying immigration directly to inflation isn't one of the points. So this is let's watch for this as a possible surprise rather than as a real forecast yet. But the reality is that the stuff that would be in an institutional portfolio for residential real estate is likely not the stuff that is going to be first affected by changes in immigration enforcement from people who aren't here legally, who often are being, they're living in quite difficult circumstances and they're often getting paid, below appropriate wages and so on. So the immediate effect isn't on multifamily housing that you would have in an institutional portfolio. But at the same time, demand for people building houses, demand for, all of the input into houses and the total number of people relative to the total number of living spaces, there is some context that over time could cause that diminution of demand for real estate. So it's not something we're seeing yet directly in the numbers, but we're going to watch for it because as we come on to this, the numbers this year are going to be interesting about the changes of population driven by immigration policy, which, by the way, is not just about, very poor people walking across the border. There's much broader changes to immigration policy, including legal immigration and so on and so forth. So it's a much more complicated story than just that. But we'll be watching that space. Tariffs, the argument mainly settled in the sense that we have moved to an environment where tariffs are a lot higher and it has not broken the world. And the theological story was that a rise in tariffs was going to break the world, and that's clearly not the case. There are going to be adjustments in behavior. There's going to be adjustments in supply chains. Some of those will have some degree of inflationary effect, although what's notable is in the inflation numbers, the areas where there's kind of like toasty inflation are the ones least affected by tariffs, and the areas where there's weak inflation are the places you would expect tariffs to be important. So
what areas are those?
I'm sorry?
What areas are those?
So things that are sort of trade, so apparel and so on and so forth are and TVs and those kinds of things that are big, well, they're all made abroad and then brought into the country. It's not been particularly noticeable certainly not today as the toasty bits of the inflation story.
Food?
Well, that's more complicated, but again, not recently. There's not a huge tie to food prices and changes in tariffs. No, not particularly.
What about energy?
Well, that's going to change. That's going to change right now, and that's the more complicated.
Not just oil.
Yeah, not really. It's not really a tariff story though so much. So,
what did Canada do yesterday?
Well, yeah.
Right.
So again, the point is not that there's going to be no effect, but that the fundamental idea that a material rise in tariffs to tariffs being a part of the tax package that the U.S. applies was going to have a crippling effect on global trade. That has been shown, certainly in the short term, not to be true. And the other effects will take time to work through. But that's the motivation behind the policy. Again, this is the political viewpoint, is the adjustments to supply chains are sort of the reason for the tariff policy. So I try and always remember that changes are never 0 or never 100, right? No change is ever as good as the people that say it's going to be, or as bad as people that disagree with it. And so we try and be studiously neutral. So I had a whole series of conversations with people around the time that Liberation Day happened. And they would go, well, no jobs are going to come back. And you go, well, no is a really big number. Well, what do you mean no jobs? They say, well, $2 T-shirts aren't going to come back from Vietnam. You go, well, maybe. But I remember I have a 24-year-old daughter. I remember when she was a teenager, I bought a whole heck of a lot of T-shirts from places like Brandy Melville that were $50 T-shirts, not $2 T-shirts. Are you telling me you can't make a $50 T-shirt in Kentucky or South Carolina or wherever, in a place where there's an empty factory and there's a high unemployment? I mean, that doesn't make sense. So probably some jobs at the margin will come back, and the question is how many? And that will take time to work out, because you've got permitting and you've got all of the stuff that takes. So just back off the political component and recognize the answer is not likely zero, and the answer is not likely all of the jobs, and we will work out over the course of this year what the effect is going to be. So does that make sense as a kind of gentle approach to understanding what the effects are, both on the inflation
You
and
need to stop watching the news so much, I guess, right?
watching the news is not good for your
It's
health.
not good.
So I try and make sure that I consume both sides, so I can throw things at both sides of my TV.
Right.
But then, as I said, you all know I'm British, and the British political structure is not covering itself with glory at the moment. So I just watch and try and see what the middle ground is. Next, year of unsurprising surprises. This is about the One Big Beautiful Bill Act. Because so much of the story recently has been about politics, and people in finance don't necessarily like talking about politics, the One Big Beautiful Bill Act is a tax adjustment that is probably going to generate growth. And people haven't been, there's been lots of talk about the controversial bits about it, but not so much about the bits that are likely to be growth stimulative, which doesn't mean there aren't going to be bad bits, because there are with any piece of legislation, but probably means there's going to be mild positive surprise from that, because people haven't wanted to talk about that for fear that they come across as making a political point. So we think probably a little bit gentle boost to GDP, which is probably good for risk assets there. Immigration policy effects clarified. That's about just saying the whole story about immigration is incredibly complicated, as anyone that's had any contact with the US immigration system will know. And there's a lot of reasons why the clarity of numbers in all kinds of different ways isn't at the forefront of most people's minds that are involved in it. This year, we're likely going to see clearer numbers about the effects of the changes in immigration policy that are happening. And one example is potential effect on rental markets. Another is about employment coming out of college. Is there a real thing or not about kids coming out of college finding it harder to get jobs because of immigration policy? There's lots of different things up and down the income spectrum, across jobs and across the country. The prediction is that we're going to get much better understanding of that, because the numbers are going to become clearer. Where the ball lands on that, I don't know. But clarity of numbers is going to be much better by the end of this year. And employment and productivity, which is one of the places we think there's going to be an effect. There's an expectation we're going to see massive growth because of AI, massive productivity growth because of AI. And some of the funkiness caused by changes to who's reported as being in the economy and how they're reported and so on and so forth may make some of that productivity gain a little bit less clear. So I wouldn't be surprised if you get, one quarter or one number where people go, well, where's the AI productivity growth? And when you dig into the number, it's masked because they've restated this number because of this policy thing and that number because of that policy thing. In other words, we shouldn't be freaking out too much if we get positive or negative surprise in that productivity story, because so many of the numbers are likely to be being adjusted and revised because some of this greater clarity we're going to get. Illiquidity risk, selection still matters. Private market investors have been having a bad time in general terms if they didn't allocate to funds that were, the top of the range. And there's lots of stories still about, endowments and foundations that went to very heavy private market allocation and made a couple of wrong calls, having real liquidity issues. Look, illiquidity is always a risk. It's never a premium in itself. The premium comes from the selection of the managers that you do business with. That's where you can generate value, and that will continue to be important this year. Last two things are sort of geopolitics and global risk premium, noisy but more peaceful, and peaceful but more noisy. We expect that the X account is likely to continue to be colorful and voluble, and we're not in a situation at the moment where normal diplomatic niceties are at the front of the forefront. So noisy, but more peaceful in the sense that we think if you look at three major areas of global tension, the Middle East, China, Taiwan, and Russia, Ukraine, we expect by the end of this year, probably two of the three of those will be materially more stable. We might have some road bumps on the way, but will be materially more stable than they were coming into the year. That's probably good for equity risk and risk in general. At the same time, we think we're going to see a lot bigger noise with friends, particularly the first issue is likely to be free speech and so on and so forth between particularly the EU and the US. But that's also, it's partially free speech, but it's also about how much do you get to regulate our companies? Because the free speech story is a lot about, can you regulate large US software platform companies in a foreign country, and so on and so forth. And there's likely to be a lot more heat in those conversations. We don't think it's going to break things, but there's a possibility the market will have a couple of freakouts about, oh my goodness, these are our friends, and it doesn't feel like it's very friendly at the moment. So noisy but more peaceful, lots of yelling, but probably the chance of geopolitical risk coming down a bit. Peaceful but more noisy, still friends, but a lot more pointy elbows in those relationships over the course of the year. So there might be a couple of road bumps that we see with people getting freaked out by that. So those are the 10 things. Some of them, no doubt, are wrong, but they're designed to be a guide for how we might think about stuff going forward. So happy to get questions or comments or violent disagreement at this point, or we can move on to capital markets.
This was 9 and 10, but whatever.
Yep.
One more question, Ian.
Please.
The current frenzy about private credit,
Mm-hmm.
I get, does that fit into illiquidity risk? And is this, I mean, more isolated worries versus systematic?
It does fit with it. So it fits in a couple of places here. It fits into the illiquidity risk because the selection matters. In other words, private credit is credit. If you hire a guy who's not good at credit for credit, you're going to have a bad time. And some people in the private credit space are discovering that component. So that's the first element of it. There are some problems in some bits of the credit market, as there usually are. It's more of a specific thing, road bump probably at this stage than a broader thing, because in fact, if you also take a step back and you say, is there a systemic problem in private credit? Well, you would also be, if there's a real problem there, that would imply implications for equity as well as credit, right? Because credit, you've got more protection than equity. And so,
well, all the PE firms have share prices have plummeted.
And that's most likely in aggregate the typical kind of story response rather than anything else.
Fundamental, yeah.
Fundamental. So you would have to see a big change in 1, 2, and 3 for us to be worried there was going to be a roll-through systemic problem in credit as a whole, and private credit's a component of credit. But the story number 8, the idea that picking your private credit manager really matters, is absolutely the case. Just like in private equity, if you're buying at the top end of the good guys, the top quartile, you'll have road bumps on the way like you always do in everything, but you'll have a good time in general over the long term. If you pick the guys at the bottom of there that are making bad loan decisions, a bad loan decision is always going to come and punch you in the face, whatever the structure of that bad loan decision. And most of the things we've seen have been bad loan decisions rather than anything else. So we're watching it. We're aware of the fact there's risk in that space, and it's certainly a story that's creating volatility, but we're certainly not freaking out about it at this point in the cycle.
Diversification is key too.
Absolutely. Yeah.
Right. No. Yeah. Portfolio well diversified loans is always key as well.
Yeah. So, any more questions or comments? And I'll happily have that conversation offline, but those last two, because in this current environment, doing this is really hard. You've got to talk about it, and you've got to be aware that people will disagree, and that is okay. We try and make sure around our table we have people that are very different with very different views, because otherwise you're just in an echo chamber. So how do we do capital market assumptions? We look at the building blocks that drive long-term expectations, that income, inflation, real growth, those kinds of things. for each asset class, and it's in our capital market assumptions book. If you're ever at 2 a.m. and you can't sleep, I guarantee you it is efficient. Within 5 minutes, you will be snoring straight away. But it's in there if you want to take a look. And so we just look at the things that drive long-term behavior. There's no opinion in this, in the sense we're feeling bullish on equities or bearish on credit at the moment. This is designed to be as dispassionate a process as possible. The only arguments we have about this are what's the best data source? How do we deal with different time periods not exactly overlapping for different asset classes? So it's designed to be violently nerdy. This is my favorite chart in all of the capital markets work that we do. This is designed to make a very simple point. So if you see the little white, is that a laser pointer?
Yeah, you should be able to.
Oh, there we are. So you see the little white dot in the middle there, right? You know, those little white dots. So those little white dots are the number that you see when you look up each of those asset classes in our capital market assumptions book, right? So our US large cap number is like wrong button. Our US large cap number, which is here, is like 5.4 or so, right? So that little white dot for US large is a 5.4. But what we're trying to do is predict the future, which is really hard. And so in fact, when anyone is doing capital market assumptions, what they're predicting is a range of outcomes. They're saying, here's the expectation with a certain amount of volatility. And so in fact, what you should think about is that's the number in the book. And there is where we expect 50% of the time, the 50% probability is between that and that, right? Because we know that there's all kinds of unpredictability in what we're trying to predict. And so it's important to be aware of where the white dot is, but it's also important to be aware of the fact that we're trying to predict the future. And really, when we say 5.4 for US large, what we're saying is somewhere between 3-ish and 10-ish. And in fact, you know, one of my maxims about capital market work is the right order of magnitude of all forward-looking investment calculations is ish, not decimal places, right? Because we're predicting the future, and that's hard over 10 years. So yes, the dots matter, and we'll be talking about the dots in a second, but you always need to be aware that the dots are really just the middle point of the range of possible outcomes. And the range of possible outcomes, I'm afraid, which makes what you all do and what we do hard, the range of those outcomes, reasonable outcomes, is actually wider than you're ever comfortable with, and you just have to accept that.
So look at private equity, right?
Yes.
So you're saying you're estimating that the return will be around, I think that was like 7.5%, 8%.
Private equity is
minus
8%, yeah.
Okay, so you say it can go as low as what, 3%?
So private equity, that's about 3%, and 3 and 13% is the 50th, is the 25th to 50th percent range.
Okay.
And the way we actually, so you just opened Pandora's box, I'm afraid. There's ongoing religious warfare about what the right way of forecasting the volatility of private markets is. And people who do private markets for a living always want a lower number, and people who do capital markets work always want a higher number. This is just the way humanity is. But we sort of came to a conclusion a couple of years ago. We said, look, the thing we know is public asset classes. If you know the length of time you're exposed to something and you know the volatility, you can predict the range of outcomes, which is actually what this chart shows, right? Well, what we know, because there's available data for pooled private market vehicles, you can find that. So you can actually observe the range of outcomes for these things, and you know how long they were in the market for. So you can back out what the volatility would have had to have been to get that range of outcomes from the products that are out there. And even if it's not exactly volatility, it's a number that does the same thing in capital markets calculations. It sort of draws the third leg of the triangle. So it's a good way of doing it. And guess what the number was? It was almost exactly the number we'd used before with the other complicated methodology of forecasting volatilities, about 25, 26%. So it seems like a good way of tying down the range of outcomes, and what we'll spend our time doing is trying to make sure that you pick the guys that produce the better outcomes. But be aware there's a lot of difference in that asset class. Also be aware how much those overlap. So we're going to want versus large cap and small cap. There's a slight difference in expected return, but really it's still U.S. equity is the underlying driver. So usually if one's going up, the other's going up, right? So there's close relationships. Return forecast this year, interest rates. When interest rates change, that drives your interest rate, your fixed income space. There were mild changes to equity. This is not a big changey year, so really the story here is not to worry about any of the individual individual changes. I mean, bank loans and private credit were down a little bit more than most things, but not in a really material way. The things that drive equity return forecasts: dividend yield, inflation, earnings growth, and valuation change. So U.S. equity is very rich relative to history on a valuation basis. So we put a small amount of negative expected return because of that. We assume a little bit of mean reversion. But most of these things, these are designed to be very long-term numbers. So this is none of this changes very rapidly. So, mild positive returns, but below the typical range you might have expected at times. It's not 7, 8, 9% from public equity, from large cap public equity. It's like 5 and a bit. Fixed income, the cash and 10-year treasury are very easy to forecast, but certain 10-year treasury is because you just say what's the new issue treasury and assume the treasury is not going to fail, and so that gives you your number, and everything builds off of that. You can forecast your credit components and so on and so forth, but nothing particularly surprising here as well. And then very little change if you look at the 10-year return. 10 basis points, again, the right order of magnitude of all forward-looking investment calculations is ish. These are always going to be approximations. So that means a mild increase in forecast 10-year return. We use the same methodology over 30 years. So again, a mild increase, but nothing that particularly changes the story. Standard deviation down a little bit, but again, this is not a particularly big year for big changes in capital market expectations. So happy to answer any questions or again comments or violent disagreement or personal insults. That's also fine. Well, if nothing else, thank you very much. It's always a pleasure. This is one of my favorite places to come, so I'm really grateful to get the time to. Oh, you say that all. Thank you for having me.
Now, when he comes to visit us in Pittsburgh.
It's a lovely place, but your grits are not to be. Thank you. My grits is excellent.
All right, next up, we have the CEO's report. We're going to let Mr. Hitchcock drive.
Thank you, Mr. Chairman. We come to certainly the most exciting part of the meeting today, which is our annual look at the annual review, beginning our annual review of the proposed annual investment plan and statement of investment objectives and policies. As everyone, I think, is aware, the commission is required to review the AIP, SIOP every year. And it's incumbent upon us to make any requested changes at this meeting that we would get your input and insight about those proposed changes, any additional changes that you all would like to see. And then we can come back in April and the commission can make a decision at the April meeting on what that ultimately looks like and is required by statute to adopt something by May 1st, hence we have the April meeting. I can say, bottom line up front, most of these changes are pretty technical or conforming in nature. We did a more significant, because of our asset, once every 5-year asset allocation exercise that we completed last year. We did some more substantial changes to the AIP, SIOP, so there's really not a lot necessarily to do, or at least from our standpoint. There are a couple of substantive changes that I'll review, but most of these are, like, for instance, on page 4, there's a date reference, and we're updating the plan funded status percentages. we're conforming the amortization periods to the actual actuarial references. We also clarified that even though we don't have net negative benefit payments now, we can expect those sometime in the foreseeable future. And then we have the, table 1 in the AIP SRAP. That's the table that James Wingo produces for us that tracks what our expectations are as far as funded status goes, and the analysis that the stochastic analysis that he does there, and it updates that to reflect the changes and the slight changes in capital market expectations, as well as what actually the impact of last year's return on the plan. And then on page 7, we also updated table 2, and that is our expectations about contribution rates. It also employs a stochastic analysis that includes the various plan components. And in this instance, we used a sample glide path for contribution rate decreases. And this is by no means should be taken as this is what the plan is, but this is more just a kind of for reference purposes or example purposes only of what could happen if we began to decrease contributions by 1% per year in 2031 and what that outcome would look like. Again, this is just for example purposes only. At this point, the way that we've done it previously is we assume the contribution rates would come down by as much as they could every year. I think that creates a little bit different of an expectation as to when we would get back to normal cost versus that we were having something that employs some kind of straw person example. So, yes, ma'am.
What do you mean by normal?
Normal cost?
Yeah.
Normal cost is how much the benefits actually cost. So the benefits right now in SCRS at a 7% discount rate, they cost about 10.89%. So the employer, right now the employer contributes 9, like roughly 1.89 of the employer 18.5% contribution rate goes to fund the rest of how much the benefits actually cost.
Okay.
Now, if you have a different discount rate, then that number can also go up and down. So, but that's right now, that's what it is. So at a 7% discount rate and SDRS, normal cost is 10.89%. And there's a similar impact to PORs as well, but I just don't, off the top of my head, I just don't know what that number is right off the top of my head.
Thank you.
Yeah. And we talked about it earlier. Most of that increase in contribution rates for the employer side actually goes to fund the unfunded liability. Yes, sir.
I'm wondering about doing that table as of decreasing rates or contributions as of 2031. That seems awfully early.
That is, that's the rate.
To even start thinking about it, because the actuary said 85% funded, there's a 67% chance, so 2/3 chance by 2035.
Yeah, well, and it's our base case scenario, and I'm going by our base case, and we think about when James runs his analysis, he incorporates for both expected funded status and as well as expected contribution rate decreases or the contribution rates. His stochastic analysis includes market volatility. So, and this is a base case scenario, obviously, which means 50% of the outcomes are above, 50% of the outcomes are below. The 2031 is just the base case where we, under our analysis, get to 85% as to when contribution rates can start coming down. So it's, that's why we did it that way, because that's where the base case is, and that's when contribution rates can start coming down. Again, it's just an example, but the way we've, and I've hopefully explained this well, the way we've done it previously, though, is instead of having some sort of schedule for contribution rates, our expectations as to when contribution rates can come down, we just have assumed that contribution rates will go down by as much as they could once we hit that 85th percentile, which creates a completely different assumption around when we would get back to normal cost. I think this is a more realistic assumption, but quite frankly, I've struggled with
both ways, kind of. So, and what the impact could potentially be on setting any sort of expectation as to when those contribution rates would start coming down at this point. But this is kind of where I've landed. And, we can, at the end of the day, we can model it any way that we want. But this is just where it can occur. It can occur naturally. It can start to occur naturally if that makes sense. So
If we're 85% funded.
correct, that's right, and that's our base case as to when we get to 85% funded. I mean, as you see, on page 53.
So will it say a 50-50 chance at that point?
Well,
Because that would indicate to readers, this is
it is
a crapshoot.
Well, I wouldn't necessarily, I think crapshoot kind of makes it sound like it's a guess, right? So I would say more of it, the better way to phrase it is 50% of the outcomes are above and 50% are below, right? So it's that 50th percentile outcome. So as you can see, last year's chart, contribution rates if we would assume the contribution rates would have, decreased by as much as they could once we get to a particular funded status. The base case scenarios, we got back to normal costs in, I think, 2040. So I don't think that's a reasonable expectation. And based on what happened last year and the returns, that would be even sooner. I don't think that's a reasonable expectation to put out there. I'm not saying that it's more reasonable. My version is more reasonable, or is the correct level of reasonableness. But having some sort of something built into the model that creates the presumption that I'm more interested, quite frankly, in this creating the presumption that there's going to be a glide path than I am necessarily in any hard or fast. This is where it's going to happen. Right.
Would it be, and so thank you for that explanation. Would it be, or I'd be more comfortable if somewhere in there we do say, even if it's just parenthetically or in a footnote, that's 50-50, but the actuary says, we only have a 2/3 likelihood probability of getting 85% by 2035, which kind of just make sure people are aware that that this is just 50-50.
Yeah,
instead of just brushing by it.
Right. Well, and I explained what the base case scenario means for both of these charts, and that this differs from the actuaries. That this shouldn't be construed as this is the actuarial version of this. This is how, because we see the world a little bit differently. We see the world as it's more probabilistic, and our analysis is more stochastic. So I think instead of thinking of those as two separate and distinct versions, I would think of those as complementary. So we're looking at it through a different lens because we know that we're managing a portfolio that's subject to market volatility, and we're trying to compensate for that in our view of the world. But I try to make that very clear.
Okay.
And also,
and I haven't read the details.
Yeah, and we can.
I'll do that.
I'm certainly open to if there's ways to make it clear. We haven't necessarily talked about the actuaries' percentage before, and when we've been doing this, and we've been doing this for years. But I do try to make it clear as possible that this is just an example. This is not should be taken as that this is how it's going to work.
Because I just don't want to create any perceptions that's going to make our job and PIBA's job more difficult to protect this plan over time.
Right.
As the funding ratio goes up.
Yeah, that's right. And so, I'm in the problem the problem that I was facing in looking at it is if we left it the way that we had done it, it would create a expectation that we would get there faster. Right. So I wanted to, and that, this, you look at that contribution rate glide path is a lot steeper than that glide path.
Yeah.
So, I'm more interested in the way this looks than I am necessarily as to when it starts, and that kind of thing. So it's really trying to enforce the concept of, or put the concept out there that the decrease needs to look more like this rather than kind of going off a cliff, right? More so like that.
Okay.
That's really the primary thing that I'm trying to get across. But I mean, look at it, and if there's some language that you think could be beneficial, I'll certainly be more than happy to look at it, consider it, so, as well. So, thank you. So, there's some reference clarifications, of like page 11 through 12. I have like an introductory sentence to just to clarify like what the purpose that the reference portfolio plays in like establishing the policy portfolio. There's a substantive change into also that conform our return to volatility expectations to the new capital market assumptions. So including the 7.3% expected return and 11.7% vol over a 30-year period. And then on page 25, I clarify that one of the things that we've done is when we think about how we're doing audited financial statement reviews and compliance and certification and fees and those things, we're trying to shift those to be more of an operational function as to actually conducting those reviews rather than using the investment team members' time and that, and a lot of the investment team members' time in that, because it is really more of an operational function, but then making sure that those results are communicated to the investment team, the CIO as a sanity check as well. So, but that's just conforming to current practice. There's a reference change on page 30. And now there are, really the two kind of substantive changes that are captured here is, and I think we've talked about this a little bit, is that, in leading up to the meeting, we have in the delegation policy, we have a 5% in between meetings limitation, meaning that we can't, our delegated investment authority in aggregate in between meetings is limited to 5%. That is not required by statute. That is just something that the commission put in place when we originally adopted the policy back in 2017. And I think that it was very much in response and thinking that it was such a monumental change from the commission approving every single investment to giving that authority to staff or delegating that authority to Brian and the staff with my oversight. So there was, a little bit of let's kind of make sure that we're not just kind of running wild to a certain extent. For us, we've never really come close to that 5%. Only, I think, one time did we come close. But it is sort of a psychological barrier for the investment team. The way that we commit capital is not evenly distributed over the year. So we think that would be better suited as a notice provision to the commission that would include if we exceed 5% in between meetings, then we would provide a notice to the commission as well as a kind of an estimate as to how much more we think that we're going to do before the next meeting. So that's one suggestion. The other one is regarding co-investments. There's not necessarily a explanation of the delegation policy of what co-investments are and the value that we get from them, and also kind of what parts of the delegation policy apply to co-investments. So I wanted to make sure that we had something in there that states why we do co-investments and their importance, and also puts an expectation on sizing of co-investments, because we're trying to build a diversified portfolio of co-investments. So we would think of that appropriate sizing is somewhere in the neighborhood of 10 basis points of plan value. And because of the speed of execution for those, we have not necessarily been posting those because of the speed of execution and their size. But I want to make sure that that's clear, that, if they're 10 basis points or below, not necessarily subject to the posting requirements. If they're lumpier, then that's something we would post. But in order to provide transparency into what we are doing in the co-investment portfolio, requiring a report similar to the delegated investment report that you get, we would do that report in executive session. You'll see it for the first time this meeting, because those are sensitive. There's a sensitive nature to those co-investments, and then being able to preserve
our ability to have access to those requires a level of discretion in that regard. So, and then there's in the one of the policies, I think it's the securities litigation policy. There's a lot of references to BNYML, and they go by BNY now, so I just changed that. But certainly happy to answer any questions. And again, this is just for your consideration. In between now and April, please look through the changes. If you have any questions, suggestions, please, feel free to reach out to me in between now and April. And, I'll attempt to incorporate any of those suggestions into a version for us to approve in April, for you to approve in April. Yes, ma'am.
I just find that last boldface there were a little hard to.
Oh, yeah. So you know how we give you like an open session, you get a delegated investment report?
Yeah.
Right. That doesn't include co-investments.
Yeah.
So in executive session, we're going to give you a similar report.
Okay.
It requires that you get a similar report that summarizes our co-investment activity in between meetings. So
Okay.
it's basically giving you more look through into what we're doing in that part of the portfolio.
Okay.
That makes sense?
Yeah.
Yes, ma'am. Any questions? Any other questions?
Anything else for our CEO? All right, I'm going to try and take a quick poll of my fellow commissioners here. Would anybody object to a comfort break right now? Or we want to keep moving and have our CIO's report?
Comfort break. Welcome.
I hear one vote for a comfort break.
I don't get a vote, but
Let's do 10 minutes, folks. We'll get back up at 11:14 according to that call. All right. Okay.
All right.
now. All right, next on the agenda is the Chief Investment Officer's report. I'm going to turn that over to Brian Moore.
Great. Thank you, Mr. Chairman. Before I get into the slides today, I want to just start with how we judge whether the plan is doing the job we expect it to do, because as a long-term investor, success isn't going to be defined by any one quarter, any one year. It's a culmination of quarters and years that go into whether we're doing a good job or not. And honestly, as we've seen in the past few days, very difficult to predict markets. Markets are going to do what they want. Our job is to really make sure the portfolio is durable and that can survive any levels of volatility when it may happen. So to really stay disciplined, I want to use 4 questions for us to think about how we want to think about performance going forward. And it's really saying, 1, is the plan compounding as we would expect? So is the plan growing? Are we able to reinvest cash flows? Second, do we have the liquidity we need to pay benefits? Do we have the liquidity needed to fund new investments? 3, is our team's execution and adding value over time is really key. And then 4, are we staying within the policy risk that we've outlined inside the policies? That's really, those 4 key questions are really things that this presentation are really going to try to answer for us. So as we go into the agenda, we're going to really address those 4 questions. First is we're going to review long-term performance. I have one of my most favorite slides in here, so looking forward to that.
We know what that
Then we're going to walk through what drove our results, and then end up with how we think about portfolio risk and how we're positioned within our policies. So moving to our executive summary at a high level, the plan continues to grow over time, over very long horizons. Liquidity is very strong. We have contributions and legislative inflows that are fully covering benefit payments. So at no point would we be a forced seller during market volatility. It's a really strong position to be in. Execution is continuing to add value, and the risk remains well within the policy ranges that we've approved. So as we shift to the longer term perspective, as I mentioned, markets are going to move year over year, quarter after quarter. And what this looks like, though, is as we look out over 10 years, both of these lines, both the plan and the policy, the plan reflects our decisions in this portfolio. The policy reflects the benchmark that we all approve. And these 2 lines lived through the exact same market over the past decade. They've experienced COVID. They've experienced different forms of aggression across geopolitical risk. They've interest rate environments. So what's really telling about this is that blue line up top is the culmination of thousands of decisions that the team has made, whether it's rebalancing, whether it's baselines that we've talked through, whether it's what managers we chose to implement through. So really, it's those small advantages that are going to grow and be sustainable over time. And that's really what I'm most excited about, is we're seeing a lot of the proof start to show up that our decisions over these past 10 years have been very value add. So as we look across different horizons, what is really nice about this is that we look over the 1, 3, 5, and 10-year periods of time. We've exceeded both the policy benchmark as well as our 7% assumed rate of return. So very important to how quickly we're getting back to being underfunded. And that's a really important place to be. Shorter numbers are always going to be a little bit more volatile. We have assets that price daily, equities. We also have assets that price less frequently. So really the longer term time periods, and this is going to be more apparent on the next slide, is going to be judged by the true economics of the portfolio, what's driving those assets.
Jim, question.
Yes.
I think you said getting it back to underfunded. I think you meant fully funded.
Yeah, I'm sorry. Clawing through underfundedness to get back to fully funded. Thank you. We don't want to go back into unfunded.
We've already achieved the underfunded.
Yeah. Sorry. Thank you for clarifying. As we look at just asset class performance, we have returns coming from multiple parts of the portfolio. Equities are outstanding. Bonds are providing some stability now, especially over the past 3 years. Private assets are continuing to compound, but there's going to be a lag to that. But what's great about this is no single asset is really driving performance here, and that's what we would expect from a diversified portfolio.
Ron, can you go back to 2 or 3 slides that showed that, that one right there. So from 22 to now, it's,
Things are really good.
it's very, very high.
Yeah.
It's just going up and to the right strongly. Does that indicate just continue to do what we've been doing with minor changes, like we just made some minor changes to the asset allocation? Nothing significant, but minor, or a little bit significant, but kind of minor. Or does that mean we should prepare for reversion to the mean and adjust more?
Yeah, so that's a great question. And what's really interesting about this slide is we adopted our baseline. So if you remember how kind of the roadmap of how we want to think about implementing each asset class. We also simplified asset allocation as well at one point during this. So we adopted baselines right here. That takes time though. As you recall, like when we do private markets, like it's a slow moving ship to really change the composition of that portfolio. So really I would say a lot of this is going to be driven by, one, the baselines really being reflective of the portfolio we want. And then two, and we're going to dig a little bit into the attribution later, but also coming through of we've made really good decisions as to how, as you see on this chart, we're outperforming in most of the asset classes and all the asset classes actually over that 5-year period of time. So it's not coming from taking extra risk. It's coming from how are we thoughtfully constructing this portfolio inside these asset classes, making sure they're behaving like the asset classes we want in the portfolio.
Okay.
Is that helpful?
Yeah.
I'll hopefully get a little bit more detail for you on this.
Okay. Thank you.
So as we think about drivers of return, it's important because we think about attribution a lot, and attribution really helps us explain where returns come from over time, but they're not really meant to be a short-term decision making. They're not meant to drive decisions for us. But really where this comes into play is attribution is really like looking in the rearview mirror of your car. It doesn't control the steering wheel, but it helps explain where we've been and what kind of drove this result. So that leads me to the attribution framework that we're used to seeing here, the boxes. And what I think is important here is with attribution is you want to make sure you have a consistent framework that you're always looking at things through. And this is our consistent framework. This has been adopted probably now, probably 5, 6 years. So we've seen this before, but what I think is really helpful with this is if we dig into just that 5-year middle box, because there's a lot of decisions that have gone into that. That's really reflective of like what I would say is a full market cycle. Over that 5 years, the implementation of our plan, the portfolio, is added about 2% annually to the portfolio. $4.6 billion of incremental value coming back to the portfolio. And what's really interesting about that, though, is you can think about portfolio construction as like our baselines, like how we're implementing the policy portfolio, and the manager selection is how well we're implementing those baselines with managers or strategies. And we're seeing excess returns from both of those. That's telling me what we're doing is really working with that. So that's really the key that I want us to focus on is, as we think about over time, we would expect both of those areas to be value add over a market cycle.
Probably not that much, but yeah, we wouldn't necessarily expect it to be.
Not this high. This is a very good period of time. But what I want to say directionally is we should expect those things to be positive. If as a commission, we want to judge us on how well we're implementing the portfolio. So digging a little bit further into the 3-year period of time, because 5 years represents, we've gone through interest rates that were at 0, and now we're, went up to over 5, and now we're kind of back in the middle. 3 years is a little bit more reflective of current market conditions. And as we look at the 3-year, this is really looking about how, this isn't really to evaluate individual decisions or asset classes, but it's really meant to show that everything works together over time. So in the 3-year, we've had a great policy return. Markets have been very strong. That's been a great tailwind, especially with more contributions coming into the plan. And even with that strong policy benchmark, we still managed to add $881 million to the plan value through different forms of implementation. And like I said, not all these asset classes are going to be positive all the time. They may be reflective of certain things happening in particular inside of this, but over time, we would expect our implementation to continue to add value. So switching over to our risk, our slides here. The expected risk that we have is very much in line with our policy expectations. So if we look at reference portfolio, policy portfolio, actual portfolio, we're all very much in the 9s. There's nothing here that is very surprising to me. But what's interesting, if you go down further here, the reference portfolio doesn't get adjusted because it's public market volatility, whereas our policy and our actual actually reflects some longer duration, smooth,
It's reflective of the difference between like an appraisal and a market.
Appraisal is the term I was looking for. Thank you, Mike.
Yeah.
So volatility is normal. And what this is telling us, that 6.4 and that 6 are really reflective of, diversification and implementation are working as designed. And what I don't see here is we don't have surprises. Everything seems in line. So we believe the portfolio is very conservative and being positioned to take advantage of any future volatility that may come about. Moving over to just our compliance slide, pleased to report that every asset class is within its allowable range. There's no breaches, no compliance areas that we need to flag. So this is one way for us to make sure that we're not taking any risk that isn't necessarily reflected inside the policy or inside what the commission has approved. And then just finishing up with the key takeaways, bringing everything together. The answer to those 4 questions we asked earlier is yes. The plan is compounding as designed. Liquidity for us remains very strong. Execution is adding value, and risk remains within the policy ranges that we've approved. So I think that's the discipline that's really going to allow us to grow this portfolio and compound over time, and really focus on how do we continue on that path to getting to fully funded that we've outlined earlier. So happy to take any questions.
All right, folks, Mr. Moore has opened up the floor for questions to his presentation. Are there any? Thank you, Mr. Moore. All right, you're up again with a delegated investment report, please.
All right, and here's our delegated investment report. These are all things that would have been provided via email to access. So happy to take any questions should there be any, but this is the report, and we'll have a co-investment report that will be separately presented later.
Any questions about the delegated investments that were closed during this time period? Hearing none?
The real asset?
Yes.
Okay, it says up to, but is that what we actually committed? It's not 20.
Yeah, the actual amount was the 526.
Okay.
So yeah, it says up to, I think when this slide was put together, we were still in that phase of figuring out what that up to amount would be. What the GP would.
And now it's just that number.
Yes, now it's that number that has been finalized.
Thank you.
Yeah,
Once it closes,
good question.
that becomes the number, once it closes.
That's all for our delegated investment report. Next up on the agenda, it's got us receding into executive session. We have a motion here. Mr. CEO, would you mind reading that for us?
Yes, sir. Motion to proceed into executive session to discuss investment matters, including the real asset portfolio's performance and a discussion of various underlying holdings and certain portions of the consolidated investment plan and statement of annual investment plan and statement of investment objectives and policies pursuant to various code sections, and to discuss personnel matters pursuant to the applicable code sections as well, and to receive advice from esteemed legal counsel pursuant to the applicable code section. Yeah.
May I have a motion as to such? May I have a second? Any discussions as we are trying to recede into executive session? Hearing none, I'll call the vote. All in favor of entering executive session, please say aye.
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 All opposed, please, the same. Guys have it. We stand in executive session. I would ask staff to take the appropriate action was taken in executive session and there aren't any votes to take place from the results of discussions in executive session. Being so, I'll call for a motion to adjourn.
Moved.
I have a motion to adjourn. May I have a second?
Second.
I have a motion and a second. Any discussion on adjournment? All in favor of adjourning, please say aye.
Aye.
Opposed? We stand adjourned. Thank you, folks.
Thank you.
Thank you.
Thank you. Great meeting.
I will, thank you. Good drive.
Thought it was gonna be a full day.